Picture this. It is a normal weekday morning. You open your banking app. It loads forever. Your card payment fails. Your paycheck shows pending. And nobody can tell you when it will be fixed. That sounds like a movie scenario, but the mechanism behind it is real. Modern money is not paper. Modern money is a network of trust, clearing, and settlement. Banks trust other banks, governments trust other governments, and the world trusts a small set of safe assets to act like financial oxygen. When that trust weakens, the first signs are not dramatic. They're quiet. They look like portfolio changes. They look like reserve managers diversifying. They look like central banks buying insurance. This video is about that quiet phase. Not about panic, not about conspiracy theories, about signals you can verify in official data. And we will use history as a map because reserve currency leadership has shifted before. The idea: reserve currencies do not die in a day. Most people imagine a collapse like a light switch.
On, then off. In reality, reserve systems usually fade like a battery, slowly at first, then faster than expected. Here is the practical way to think about it. When a country sits at the center of global finance, three things tend to happen over time. First, the country issues the assets everyone wants to hold, usually government bonds. Second, success makes borrowing easy, so debt rises, often for wars, bailouts, or big domestic programs. Third, foreign holders start to reduce concentration quietly, not because they want chaos, because they want options. That third step is what matters most for regular people, because it changes liquidity, it changes interest rates, it changes how fragile the system becomes under stress. So let's ground this in real examples. Case study 1, Spain in the 16th century. Spain was not poor in the 1600s. Spain was loaded with precious metal flows from the Americas. Spain also had massive military obligations across Europe. The key detail is simple. Spain borrowed heavily and then suspended payments multiple times under King Philip II. Those suspensions happened in the same century that Spain was still a major power. That is the pattern people miss. Military strength does not cancel financial arithmetic. When creditors stop trusting repayment terms, they demand better collateral, higher rates, or different settlement. Over time, capital seeks a new center. The center moved, not overnight, but it moved. Case study 2, Amsterdam, banking innovation, and the limits of perfect safety. In the 1700s, Amsterdam was a financial engine, and one of its crown jewels was the Bank of Amsterdam. It built credibility by offering stable bank money people trusted more than coins that were often debased or inconsistent. But later, the bank's balance sheet became more complex. Research shows it expanded lending and became more entangled with government-linked finance and large institutions like the Dutch East India Company. The important lesson is not banks are evil. The lesson is structural. When safe institutions quietly take on risk to support the state, stability can look fine until it suddenly does not. That is a reserve system warning sign, when the system's reputation is cleaner than its balance sheet. Case study 3. Britain and the long retreat of sterling. Britain ran the dominant reserve currency for a very long time. But the 20th century was expensive. After the Second World War, sterling faced repeated pressure. By November of 1967, Britain devalued the pound from $2.80 to $2.40, about a 14.3% devaluation. Later, in 1976, the United Kingdom negotiated an International Monetary Fund standby arrangement during a severe confidence episode. Notice what is happening in all three stories. The reserve role does not vanish because a country loses. It weakens because the world chooses alternatives at the margin, month after month, until the margin becomes the main story. Now let's talk about the present using verifiable numbers. The modern signals, debt, reserves, and insurance buying. Start with the anchor asset of today's system, United States Treasury securities. They are widely used as collateral. They are held by institutions worldwide. They backstop liquidity. Foreign ownership data is published by the United States Treasury through the Treasury International Capital System. As of November 2025, reported holdings show Japan, about $1.2 trillion, the United Kingdom, about $0.9 trillion, and mainland China, about $0.68 trillion. That China number matters because it used to be much higher. A U.S. government research brief noted that China's treasury holdings were around $1.3 trillion in the early 2010s. So yes, China's reported holdings have come down materially, but do not stop there. The more important question is, what is being done with the diversification? One answer is visible in gold. China and gold. The move you can actually track. China's central bank reports its gold reserves. Independent groups compile those reports. According to the World Gold Council, China's official gold reserves were about 2,306 metric tons at the end of 2025. Reuters reporting also notes that China resumed reported gold buying in late 2024 after a pause, and then continued adding gold month after month through the end of 2025. Is that automatically a plan to crash the dollar? No. That is not how large reserve managers behave. It is better understood as insurance. Gold is an asset with no counterparty risk. It is not somebody else's liability, and it can be held outside the banking system. That is why gold tends to reappear in reserve discussions when geopolitical and financial uncertainty rises. And China is not the only actor. Central banks as a group are also buying gold. The World Gold Council has documented that central banks have been buying large amounts of gold in recent years. In 2024, central banks bought more than 1,000 tons of gold, according to World Gold Council reporting cited by Reuters. Reuters also reported survey results in which 95% of surveyed central banks expected global official gold reserves to increase over the following year. Again, that does not mean collapse tomorrow. It means the institutions closest to monetary plumbing are increasing insurance allocations. That is worth paying attention to. The United States debt picture in plain language. Now let's connect the reserve asset to the issuer. The United States national debt is publicly reported by the Treasury. As of January 21, 2026, total public debt outstanding was about $38.47 trillion. Debt alone is not the whole story. The cost of servicing the debt matters. The Treasury's fiscal data shows net interest outlays have risen sharply in recent years. When interest costs grow, the government has fewer choices: raise taxes, cut spending, borrow more, or rely on inflation and financial repression. None of those options is painless. Liquidity and money growth. What the data shows. To understand stress risk, you also watch liquidity conditions. One commonly referenced measure is M2, meaning a broad measure of money supply. FRED, the data service of the Federal Reserve Bank of St. Louis, shows M2 rising from about $15.5 trillion in February 2020 to about $21.7 trillion in April 2022. That period was unusual. It included pandemic-era interventions and massive fiscal response. And large liquidity expansions often show up in asset prices. For example, the National Case-Shiller Home Price Index rose from about 212 in December 2019 to about 328 by October 2025, roughly a 55% increase. That does not prove collapse, but it does illustrate the environment reserve managers are reacting to: higher debt, higher interest costs, and a recent era of extreme liquidity policy. A key reality check: the dollar is still dominant. Now, it is important to be precise. De-dollarization is often exaggerated. The International Monetary Fund's COFR data shows the US dollar still makes up the largest share of disclosed global foreign exchange reserves, around the mid-50% range in 2025. Also, foreign holdings of U.S. Treasuries overall have been very large, and in some periods have even reached record highs. So the story is not everyone is dumping everything. The story is more subtle. At the margin, some large holders are reducing concentration, and at the margin, central banks are increasing gold as insurance. That combination is the quiet phase you watch. What this means for a normal household, let's keep this practical. This is not financial advice. It is risk management education. If you assume the financial system is always liquid, you are exposed. because systemic stress is not only about prices, it is about access. So here are sensible, non-panicky steps people often consider in uncertain periods. 1. Keep a real emergency buffer, not to time markets, to avoid being forced into bad decisions. 2. Reduce high-rate consumer debt where possible. Credit card rates punish you in tight liquidity environments. 3. Avoid concentrating all cash in one institution. Diversification is not only for investments, it is also for access. 4. Understand your own exposure to interest rates. If your life breaks when rates rise, that is a vulnerability. 5. Invest in skills that raise your income resilience. History shows that human capital can outlast currency regimes. None of this requires predicting a crash. It only requires acknowledging uncertainty. What I would watch next: if you want a short dashboard, here are the data releases that matter: United States Treasury International Capital Reports, foreign holdings, and flows. China's reported gold reserve updates, tracked by the World Gold Council and major financial outlets. IMF COFR reserve composition trends, which show whether the dollar share is drifting, and the United States debt and net interest trajectory, which the Treasury publishes. Here is the bottom line: reserve currency systems do not usually explode without warning. They usually leak credibility, then liquidity, then stability. The leaks are measurable, not perfectly, but measurably. And when you base your views on public data, not fear, you make better decisions. If you want a follow-up video, I can write part 2 on what tends to hold up well in inflationary versus deflationary stress, using historical evidence and modern portfolio research. For now, stay curious, stay grounded in primary sources, and do not outsource your worldview to headlines.